All right, what is up, guys? We're experimenting with different kind of lighting, so you don't have this bright spot in the middle of my face. Because I know if I use the webcam one, you get this. There it is. Oh wow, I can't point this stuff right in the middle of my glasses. Right there. Yeah. So turn it off. Try this instead. Anyways, I wanted to talk about the recent monetary report that came out from the Federal Reserve and everything else. Just let me share my screen. Might actually just share the entire screen. Yeah, see how that goes. So we'll do that, and then we'll go over here. So here it is. Okay. All right. So basically, what this is the monetary policy report that's submitted to Congress, right? And this is done twice a year. From what I've noticed, it's pretty much always in February and then sometime in June or July ish. It's twice a year. Basically, it's submitted to both the Senate Committee on Banking, Urban Development, and a long line of committee stuff. Same with the House. I wrote it in the description because I didn't memorize it, to be honest. I don't remember them off the top of my head. They're written there though. Um, so basically, it's kind of a summary of monetary policy, economic and financial development, stuff like that. Let's just get right into it. So basically, they say that U.S. economic activity posted further impressive gains in the second half of the last year, so 2021, but inflation rose to its highest level since the early 1980s, which is not a surprise to anyone who pays any attention to that kind of thing, and economics in general is very well aware of that. I think I was listening to a podcast this morning, and they were talking about how it is inflation's the number one topic in America right now in terms of like politics and stuff like that. The labor market tightened substantially further amid high demand for workers and constrained supply, with the unemployment rate reaching the median of the FOMC's participants' estimate of its longer run normal levels, and nominal wages rising at their fastest pace in decades. Wages have been increasing as well. I started to see this late last or early last year. I remember going to Sonic to get ice cream and stuff, and watching them post on the. They had posters all over the place about how they're hiring because they were severely understaffed, and they were starting at like $10 an hour. And in high school, when I worked at Sonic, I mean, like I got paid tip wage at 3.25, and so it's kind of like, well, well crap, should have waited. But still, it's one of the things that's a completely different topic. But wages have been increasing and stuff like that too. I saw an interesting graph. I don't have it pulled up or anything. I might try to find it later because I liked it so much. Basically, showing nominal wages versus real wages and how real wages have been tanking, which shouldn't be a surprise, as normally happens in an inflationary environment. Um, that's why a lot of the times you see nominal instead of real. Insert whatever indicator you're talking about. Okay, so on the second half of the last year, the FOMC held its policy rate near zero to support the continued economic recovery. Not a surprise, we all know that interest rates have been near zero for a while. And this is talking about Fed funds because that's pretty much it's not the only rate they have anymore, because they also have reverse repo, which we'll get into. It's noted later. But typically, what they're talking about is Fed funds, because the Federal Reserve doesn't directly set like Treasury rates and stuff like that. That's based off of the market. They can influence them and arguably peg them and stuff like that. But that's something separate that we're not going to get into right now. And the committee began phasing out net asset purchases in November and accelerated the pace of the phase out in December. Net asset purchases will end in early March. This part's just a summary. We'll get into actual numbers later in the actual report. It's not that long. Um, so basically, in the second half of 2021, GDP growth slowed somewhat from its brisk first half pace, but nevertheless rose at a solid annualized rate of 4.6%. Um, I'm not sure if that's for the whole year. It seems like because we're only doing like in between reports, at least to my knowledge. So I'm pretty sure this is annualized rate, and so I'm assuming it's from the previous report, which I think was in last July, if I remember. So from July 2021 to a few days ago, earlier this past week, the annualized rate was 4.6% nominally. So the tight labor supply in conjunction with a continued surge in labor demands has resulted in strong nominal wage growth again, especially for low wage workers. How I brought up the Sonic employees and everything else. Then their supply bottlenecks also continue to significantly limit activity through the second half. We've pretty much all heard about the supply bottlenecks. Um, Grocery store shelves aren't as full as they used to be, or at least in some areas. And in some of the areas, it's completely different. Um, like a few months ago, when I was still living in Tennessee, we didn't really have much of a problem with the grocery stores were still pretty much full. Now that I moved down here to Florida, it's completely different. Even and prices are significantly more too. Like I eat a lot of eggs just because it's part of my diet and everything else, and so I get those at Walmart, those big crates of the 60 eggs in a thing in a big box. In Tennessee, those are like they're like $5 for 60 eggs. Here they're 10. And same with the price of chicken in Tennessee was $2 when I left, $2 a pound, and down here it's 3.5. So, or at least where I was going, haven't found somewhere cheaper yet. So that's where we get into inflation is the next topic. So the personal consumption expenditures. PCE, the price index, rose 5.8% over the 12 months ending in December. So that is all of 2021. Um, and the index that excludes food and energy, it's also called core CPI because, our core inflation and everything else. I never really understood why, we call it core inflation because it's excluding food and energy, which for kind of middle to lower class people, food and energy is the vast majority of their expenditures typically. It's always the grocery bills and utilities because, at least from my experience, yours might be different, but that's what it seems to be, at least to me. So it seems kind of pointless for that kind of demographic. Um, and this was up 4.9%, both the highest readings for both measures in roughly 40 years. So, same thing happened in services. Everything else, all that increasing, strong wage growth in some service sectors as well, and rents. Rents have been going up a lot too. And I highlighted this in blue because I really wanted to separate it from the rest. But while measures of near term inflation expectations moved substantially higher over the course of last year, measures of longer term inflation expectations have moved up only modestly. They remain in the range observed over the decade before the pandemic and thus appear broadly consistent with the FOMC's longer run inflation objective of 2%. Okay, so basically, I had never heard them differentiate between near term and longer term inflation, which I mean, like obviously there's a difference. And they seem to, and they're kind of driven by different factors, I guess. But just reading this and everything else reminded me of kind of an argument that I've been hearing a lot. Basically, I mean, nothing goes up in a straight line, whether it be a stock or inflation or anything else. Just look at the 1970s. I mean, it was not like it was 20%, or I think in the 1970s it was 14 point something at one of the years, and then it would go down, and then it'd go back up, and then it'd go down, and so on. It looks kind of like a stock chart. It's not in a straight line. But keep in mind that we're talking inflation is a rate. It's not really a value in and of itself. It's a rate of kind of the purchasing power of your money in a way. So just because it's the difference between inflation and disinflation. It's not deflation where that rate is negative. It's still positive. It's just a lower positive value. And so the inflation is still happening just at a lower rate because this 2%, this is a rate. It's a ratio, but still it's the amount of inflation that's happening. 2% growth. It's a rate that's applied to the previous number, right? So whatever it cost you to buy, say, bread, we'll just call it $1 or whatever, for an example, because just an example. You basically have, so it takes $1 to buy bread, and then next year in 2% inflation, it takes $1.02. And then the next year you have to multiply the $1.02 by whatever the inflation rate is to get the next number. It's a rate, and this is kind of similar to the same kind of math that you deal with the GDP deflator and everything else. That I did a post about that. It's in one of the videos here too. Financial conditions. So bank lending standards have eased across most loan categories and bank credit has expanded. All told, financing conditions have been accommodative for businesses and households. I thought this stuff is kind of interesting because I've seen a lot of, I have a lot of interest in like real estate and everything else. And so comparing what's going on now to say like the GFC, so like in the real estate market crash and everything else, just seeing how different it's like there's different buyers now. Everyone blamed 2000, or at least the real estate part of 2008, on like subprime borrowers and stuff who weren't able to fill out their debt obligations, right? And I've seen some things. I think it was an argument on the Bigger Pockets podcast. I don't remember which one, but one of the recent ones, like maybe in the past couple weeks, talking about how it's a different kind of borrower now. You're having more of investors and stuff coming in and buying up rental properties rather than just like janitors trying to buy McMansions and stuff. Someone who makes like $20 an hour is not trying to get a loan for a $500,000 house. Stuff like that. Well, it's just something that's interesting that I kind of want to look into more, and we'll see what happens. But just thought it was interesting. So while some financial vulnerabilities remain elevated, the large banks at the core of the financial system continue to be resilient. Measures of valuation pressures on risky assets remain high compared to with historical values. Non-financial sector leverage has broadly declined, and credit growth in the household sector has been driven almost exclusively by residential mortgage and auto loans to prime rate borrowers. This is so saying kind of what I was going on earlier about basically the people who are actually borrowing the money or people who can pay and can service the debt. Again, keep in mind, this is all just sourcing. This is coming from the Federal Reserve. And so with kind of price stability and everything else, they kind of have an incentive to, there's a possibility they're biased. I'm just kind of going and talking off of what they're saying right now because that's what's in front of me. I haven't dug up anything that says otherwise, really. Otherwise, it'd just be opinionated, as this probably is, as this is. It's biased, obviously. But anyways, the Federal Reserve continues to evaluate the potential systemic risks posed by hedge funds and digital assets and is closely monitoring the transition away from LIBOR. This is something that I'm still fuzzy on. I've looked a little bit into LIBOR. I honestly don't know a lot about it, but one of the main sources that I've been going to when I try to figure it out is the is Eurodollar University by Jeff Snyder and Emil Kalinowski. I know that they're transitioning from LIBOR to something called SOFR. Now, the actual like plumbing on what that means and stuff, I'm still I still don't understand. I don't understand it at all, to be honest. The euro-dollar system and everything else is still something that I haven't spent a lot of time studying. Um, it's just I kind of, and that's something that's definitely on my list to actually learn about, and I want to learn about it. And I've been listening to their content and stuff as it comes out, trying to figure it out. Just haven't been exposed to it long enough, I guess. Okay, so inflation rose notably in many economies in second half of last year, importantly boosted by higher energy and other commodity prices as well as supply chain constraints. Same thing. Several emerging market foreign central banks have, and a few advanced economies foreign central banks have raised policy rates through foreign monetary and fiscal policies have generally continue to be accommodative. So other countries are raising interest rates. I don't They don't state which ones. I haven't looked into it too much, but I mean this isn't just in America and everything else. All the inflation and everything else. I know, like listening to George Gammon's Rebel Capitalist channel and everything else. He's talking about in Colombia right now, food's going a hell of a lot higher than it is here, if I remember correctly. And so, yeah, you never know. Um, Also, this is the trade weighted value of the dollar appreciated modestly on net over the past 6 months, and then Ukraine, Russia, because this came out the 25th, which was Friday. So yeah, very recent. And I think Russia invaded what, Thursday, if I remember. I think it was Thursday. Um, so yeah, there's that. Interest rate policy. So, with inflation well above the committee's 2% long run goal and a strong labor market, the committee expects it will soon be appropriated to raise the target range for Fed funds. Um, Big surprise has been near zero for how long and everything else. So, raising interest rates. Maybe. They always use language to where they can back out if they need to. Um, Always leave a way out, I guess, in terms of politics. Um, I've seen some things to where people were talking about like how the markets have priced in like 6 or 7 rate hikes and stuff like that. And there's a lot. It's a big topic, so there's a lot of things going on there. Anyways, basically, general consensus is they want to raise interest rates. They kind of have to, or well, different topic. That can be a rabbit hole, all right. Okay, so and then basically a balance sheet policy. This is your QE and QT, so like quantitative easing or quantitative tightening. And so we know that here are some actual numbers and stuff. Basically, when they do QE or QT, they have to buy. They typically buy United States Treasuries or mortgage-backed securities. At least those are the ones I know of. And they're also the ones stated here. And so basically, since June of 2020 to late last year, they were buying 800 billion per month of the treasuries, and then 40 billion a month for mortgage-backed securities. And basically, they started tapering that down and everything else. So yeah, they talk a little bit about that here, and then they decided they needed to do it quicker because inflation was getting out of hand. And then now we're here in the very end of January. So in the next Fed meeting, I think they were supposed to have it done, and then actually start QT, and we'll see how that goes. Because I honestly have no idea. So low labor supply, people don't want to work. Big surprise. Basically, low labor supply has been slow to rebound even as labor demand has been remarkably strong. The labor force participation rate remains well below estimates of its longer run trend, principally reflecting a wave of retirements among older individuals and increases in the number of people out of the labor force and engaged in caregiving responsibilities. So again, I mean, baby boomers are retiring. I mean, we have one of the largest generations in American history just becoming retirement age, and what do you expect? So there's that. Wage and employment gains are widespread across jobs and industries last year, with lowest wage jobs experienced the largest gains of both median wages and employment. Yeah. One of the things that I noticed about the whole jobs thing and everything else, job growth, which I mean, like when you see how many were lost in 2020, I think mostly 2020, and then we're talking about like best job growth ever in the past whatever, and now Biden's some, I don't know, come to Jesus of job growth. I mean, like and also they're saying like I don't know if they specifically say retail, but I think yeah, wage growth in leisure and hospitality industry. Let's see, yeah, yeah. So the lowest wage group jobs and everything else. I mean, those are the jobs that were deemed what do we call it, unessential or whatever. They weren't considered essential. Some retail was the big retailers like Lowe's, Home Depot, Walmart, and that kind of stuff, obviously. But still, when you destroy that many jobs because of your policies and everything else, and this isn't partisan whatsoever, that's just in general, when you destroy all these jobs, it's not that a lot of these jobs are new, it's just people are going back to the jobs were already, um, you're restoring jobs that were already destroyed, at least on aggregate total. And then supply chain bottlenecks, basically signs of improvement, um, but not expected to resolve for any time soon. Um, right. And then here, so let's see. Basically, going on the repo rate and everything else, which I've been studying a bit more because it seems really interesting. From what I can tell, this is a lot of like for short-term liquidity and everything else in markets. Um, like literally like overnight repo where it's only there like you're basically you loan the Fed money for literally just overnight and get paid some minuscule rate because it's only overnight and you have to do something with it. Um, Stuff like that. It's supposed to set a floor on short-term interest rates. And there's a huge this is a huge rabbit hole, and if you are more interested in it, you can go to a lot of watch a lot of George Gammon videos because he does a lot of videos on this, and it really helps you make sense of it, or at least it does for me. I need to go through and watch quite a few more because he does a really good job of explaining that kind of stuff. And then it's their statement in general. Basically, just reaffirming it that I mean, this was adopted in 2012, and so I think they just reinstate this every year. Um, Again, they're wanting inflation to average 2% now instead of just be each year be 2% or less. It's now gotta average because it's at like 7.6 or whatever it is right now. It has a 7 handle. So, anyways, this was one of the things I saw was interesting is that the committee intends to review these principles and to make adjustments as appropriate at its annual organization meeting each January and undertake roughly every 5 years a thorough public review of monetary policy strategy, tools, and communication practices. So this thorough review is every 5 years. That seems kind of. I feel like it should be more frequent than that, but whatever works. Also, there's a lot of things in here that you can click and stuff. So I would highly recommend. Like they have other stuff where you can click on it and go to it. I don't want to make this video any longer because I'm pretty sure it's already 25 minutes. So there's that. But yeah, go read it yourself. I feel like this kind of stuff is pretty important to understand, just like the economy in general. Not even if it's like whether you believe the Fed or not. I mean, like it's still. I think it's worth listening to their opinion because at least by knowing what they're saying, you get that side of the story, and then you can see what actually happens and see where things kind of differentiate between what actually comes out of their mouth. Um, so yeah. See, that's all I got, and I'll stop sharing. There we go. So yeah, that is this semi-annual monetary policy report as of February 25th in 2022. So the next one will probably be out like in June or July, and I'll probably go over that one as well. This was just the summary, but I think it's definitely interesting and worth going into. So anyways, I hope you guys have a good day, and I'll see you guys in the next video.